Stanlib's balanced fund is aimed at investors concerned that money and income funds are unable to give them positive real and after-tax returns. The fund is positioned to provide an 8 to 10% return over the next year by applying various correlations of assets. Herman van Velze, head of Stanlib's balanced fund, is here to share the team's contrarian style of investment and how they're positioned for the year ahead. And I think that's probably a good place to begin. The contrarian style of investing, how do you define it?
Yeah, it's been an interesting journey in terms of contrarianism. The history of contrarian style was that you would stay with the big winners and you will ignore the opportunities elsewhere. And the last few years, that contrarian style has actually turned around on its head. And the last year or two, and especially last year, the growth shares, the highly rated, the retailers, the consumer shares have been the contrarian investments in South Africa. So from being the loved shares, the shares that do well, have performed exceptionally in the last few years. And that's been the contrarianism that we've applied.
Are you changing anything as you go into 2013 without giving away any of the state secrets?
No, the question has crossed our mind numerous times in the last while. But I must say that since probably the last quarter, we've moderated our stance, but we've not capitulated at all. We still are of the opinion that our style of investment, looking for companies that have growing revenue streams, expanding margins, are the place to be. And don't get all bogged down with the actual share price and valuation. So a bit more share price agnostic and more focused on companies.
Just looking at what we've seen over the last year, resources obviously underperformed the rest of the markets, no secret, with retail shares outperforming. Do you believe that resources are now going to come around to the positive in the 2013 period?
We still remain underweight resources. My background is resource analyst, and when commodity prices are high, resource shares are reluctant performers. So maybe there's a bit of sector rotation, but we don't see a big resource boom.
What would be a kicker for a resource boom? Is that linked directly to the China story?
I would think lower commodity prices as a precursor and rising interest rates. So you need something else to give. It's not just going to happen out of its own. Rates got to rise very quickly, which would effectively mean that economic activity is back on stream and demand side is up. And we just can't say that's going to happen. And
you mentioned that consumer shares have been a very robust theme for you and that there is some moderation as you go into 2013, but it's still going to be a principal focus.
It remains a focus in South Africa. It's still the best sort of investment for investors to get the returns they've been expecting for the last few years. The business models are conducive for the type of country we are. We import at lower cost and we sell at the inflation-adjusted pricing. So at the end of the day, shareholders will get a decent return as they've had for maybe a decade now.
You're not unnerved by Shoprite's move yesterday, down some 6%, all these stocks priced for perfection?
Now there are obviously a few exceptions that have been quite astounding, and we've moderated our stance and we sold our Shoprites last year. And we still retain Woolworths for one, and we still have a few left, but we're definitely not as gung-ho as we were a year ago, so there is some moderation.
You mentioned Woolworths. It's been a stellar performer for you, and I assume you're going to be holding on to this one for the longer term.
Yeah, that's a share which we're quite comfortable that even with the sort of latest adjustments and down 10% this month, we're quite comfortable that that's the share that we'll retain as our sort of key retail share going forward.
Financials, let's touch briefly on your view there. You are underweight the banks and you're pretty neutral when it comes to the insurance companies.
We're underweight financials. We just don't see that the ability to price, demand side, credit demand, the cost increases that they need to face, the inefficiency in the business models that they need to rationalize. It just remains for us still an area of no-go for some time. And globally, financials are struggling. They move from one problem to the next. There's one disappointment, there's a restructuring, layoffs. There hasn't been a happy sector.
They don't form part of that positive consumer story, the banks in your book?
No, we remain focused on the industrial side. That's where we see the Imperials, the conglomerates in South Africa to be a better position than the banks. Life insurance is interesting as long as rates hold, and we've seen interest rates go. There's been some reasonable good payoffs to shareholders, so we prefer the exposure there. But
which is your preferred entry into the life insurers?
Our preferred entry remains MMI. It's still the share that we think is what Sanlam was 5 years ago. So if you just follow the route that Sanlam took in the last 5 years, and you can more or less project the new 5 years profile for MMI if you had to do a sort of rough estimate of what sort of broad thinking we have on the MMI story.
You like Life Healthcare Group. I see it's among your top holdings. Is there, I mean, have you held the position for some time?
Now, we were originally part of the consortium that took it out of the private equity space when it was listed, and we haven't sold one share since then. As long as the insured lives in South Africa grow, and they're growing at about 2-3% every year, we are in a good position as a life healthcare shareholder that we will be the beneficiaries as people seek further services from the hospital groups. And it also spans from the various populations, from the managed care right up to the premium customers. So we think the overall outlook for life health companies in South Africa, and especially life health, is still astounding. And
are there any other players in the healthcare environment despite or besides life healthcare?
We probably are of the opinion that all the private healthcare companies will do well. The competition for the private healthcare is the state, and we're not concerned that state competition will erode the private sector. So if we have life health and Netcare as our two main shares in that category, but a Mediclinic would be serving the same purpose more or less.
Let's just go back to the resource theme. You are underweight resources, but you are overweight when you're talking platinum and gold. Is that correct?
Yes, yeah, we've taken a stance that the difficulty in the mining industry does not necessarily preclude us from the commodities. So we've gone the route of owning more of the direct commodities via the ETFs. So we've sort of steered away from platinum and gold shares and went for the route of least resistance and bought the actual ETFs.
And of course then you don't have the quagmire associated with deep level mining, labour costs, electricity costs, etc., etc. You just get a pure play on the metal.
Yeah, and to be honest, that for any of the mining shares to perform, the commodity price has to go up. No mining share in South Africa is going to perform if the commodity price doesn't assist. There's no the X growth, they're not going to improve ounces or production. So our opinion is that if we have the resources wrong, and especially the precious side, may I also add there that Billiton is still a large share.
I was going to say, now I was coming to that and going, do you remember that you hold BHP Billiton?
We are selective, we've been selective buyers of some of the shares again that actually can grow volume, and we think Billiton is to us still the pick of the crop. And in my years of experience, every time you sell Billiton, you regret it. So.
Well, of course, that brings us to Anglo-American because of all the news flow. Marco Tufani, we were chatting about it last night. Everyone was talking about it last week when he was appointed as Cynthia Carroll's successor. Does that, it's a fundamental change for the company, which has been underperforming. Much shareholder wealth has been destroyed over Cynthia Carroll's tenure. Do you believe that Marco Tufani could be a game changer, and are you looking at Anglo-American with renewed interest?
We would probably still steer away from Anglo. It doesn't, the projects and the problems that Anglo is experiencing today will not go away with just a change of the CEO. They're projects that are struggling, they're battling to find new growth areas. So we clearly, for us it doesn't make sense to convert Billiton back into Anglo. Anglo has got structural problems, and it may take years for you to see if they're actually going to get out of them. Potentially it will get worse before it gets better.
So Marco Tufani's got a very tough job ahead of him.
And he knows that, I'm sure he knows that. So it's a tough job ahead, and we'd probably be more comfortable with staying with the Billiton.
If you like a diversified play like BHP Billiton, what about African Rainbow Minerals? Does that not fall into the same camp?
The African Rainbow Minerals and Exxaro are secondary shares we would own, which we currently own. They sort of bolster the diversifieds.
So it follows the same theme?
Same theme. In South Africa, we think they probably got the best attraction. They can all grow volume. They've got some reasonable project pipelines. So from our point of view, those are the ones we would probably still retain for some time.
The JSE All Share up 23% over 2012. That was the All Share. What are you expecting from 2013? I mean, if you're looking at that as kind of an indication of how the market performed, some people say they can't believe the market actually did so well because it seemed as though it was such a tough year. What do you think 2013 holds for us?
We sort of think double-digit returns, sort of 10 to 12 will do us fine. And we'll be quite comfortable getting that after achieving what we achieved last year. And compare that against most other potential asset classes we could invest in. That looks quite attractive. So we still think that equities is the place to be. And it's hard to say if we can have another stellar year, but that seems pretty unlikely.
Herman, any major concerns on the table? Any red flags that you'll be looking for as we go further into the year?
What worries us a bit is the overall consensus that has become so bullish across the world for equities. Everybody is talking a good story for this year. It happened a few years ago and there was some tough times ahead. Just that sort of general comfort and consensus that people are positioned. So we feel that's probably...
So beware the comfort zone.
The comfort zone, and too much sun and too little cloud is what BCA was sending out some documents today, and that concerns us. That's just the general consensus that things are great.
All right, so bring on the clouds is what you're saying.
There's going to be some cloud, and that's a concern. If there was less consensus on equities, we would feel a lot better. But it's just, we still think that the cycle is very elongated, so rates will remain low, uneventful items, and people will have to find newsworthy matters and elsewhere. So it's possible that we're still going to have a more or less similar environment as the last few years, but it doesn't mean assets may reprice the same rate. That's the only caveat in the whole scheme of things.